June was a brutal month in the markets, and it ended the first half of the year, which was the worst Nasdaq first half of the year in history. This was incredible, guys. So where do we stand? My name is Paul. I run Everything Money. We're value investors, and if you've watched any of our videos, you'll see I like to look at long-term numbers to determine where the market's at. I don't follow hype. We don't follow hype here. Three main valuation metrics in the market. Stock market to GDP ratio, which Warren Buffett absolutely loves, price to sales ratio, and the 10-year cyclically adjusted PE ratio, which was made famous by Schiller. However, it was used back in the 1930s and 40s by Ben Graham. So the historical average for the 10-year cyclically adjusted PE ratio is around 15 or 16. We are currently, after the worst half ever in stock market history at S&P, sitting at 29.4, Seth. Double.
What does that mean to me?
So that means that there's going to be a lot of problems in the market for the foreseeable future. Guys, does this mean you sell everything? No. It got as high at almost 40 recently. So just remember that your job is the dollar cost average. But I have some more bad news. The stock market to GDP ratio, which is Warren Buffett's favorite, the historical average is around 75 or 80%. It's currently at 155%. So pretty much in line with the 10-year cyclically adjusted PE ratio, about double.
Jeez.
It was a little bit worse. The price to sales ratio historically has been around 1, but it's currently at 2.4. Now, with that said, historically is driven a lot by manufacturing, but right now we are more of a service-oriented business, so I can understand a higher price to sales ratio, but it's still screaming really high number at 2.4, right? So again, you're feeling scared, but I'm going to tell you guys, there'll be better times ahead. Your job as a good investor is to sit here, and the market value is going to go like this over time, but the market price is going to go like this. You're not going to be able to guess this or this ever. Please take it out of your desires. Just avoid. Once I started to realize that, investing became easier to me. Why? Because I wasn't always trying to get this bottom. And for those of you who have friends who say, oh, I bought blah, blah, blah stock at blah, blah, blah price, and it's always a low, they're what we call compulsive liars. Get them out of your life. Don't talk about money. Your job is to buy all along the way. Because what happens if you buy all along the way, Seth?
Your dollar cost averaging in, which just took me some time to figure out.
But what you're buying right here along the way on average.
Of course.
And by the way, when you say it took you a long time to figure out, what do you mean by that?
Because I would think a natural concept would be, it looks bleak, I should sell. And then when it looks great, I should buy.
So great point, Seth. So what I encourage you to do as an investor out there is if you hear what Seth says and says, yeah, it's true, just go back and look at all the dire times in history where stocks fell 40, 50, 60, 70. In the Great Depression, 85%. Go look at the bottom of those parts. Wouldn't you have wished that you had bought at those times? Every single time in history, when stocks fell, in hindsight, you'd have thought, damn, I wish I bought there. But in the middle of the emotion of it, you sit there and say, my money's going to go. How many people I've ever heard say, I just don't want my money to go to zero? Spoiler alert, if you're in a diversified ETF market-based, if the market were to go to zero, do you know what that means? That nothing in the world matters. It's literally whoever has the most guns and land are going to win. Guys, stocks are not going to zero. This is your goal right here. You're going to overpay sometimes, you're going to underpay sometimes, but your goal is over time, you'll get this average and you'll be so happy you did. Take the guesswork out of it. It's too stressful to try to guess. Avoid that completely. Now, with that said, more bad news. Now, Powell came out yesterday and said the economy is on good, has good foundation to it.
Mm-hmm.
Listen, he's the Fed chairman. He's a smart man. But I want to remind everybody how Alan Greenspan said he didn't see any frothiness in the real estate market in 03-04. He's still human. He still has job risk. If you go look at Powell at the end of Obama's term and early Trump term, he said, we can't have rates being this low. All of a sudden, he gets a little pressure from the president. What happened? He's driving rates even further down. So he's still a human like you and I. Take what he says with a grain of salt. Because of the internet age, he's out there in front of people all the time, and people would hate him if he said something bad about the economy. But I will say this. Go look at history. Our current unemployment rate is 3.6, 3.7%. In the future, is it likely to go lower, stay the same, or higher from here?
Higher.
Of course. And guys, guess what? That's okay, because right now we're dealing with a lot of inflation. And how do we fight inflation, Seth?
Oh my gosh. How do we fight it?
Yeah.
Well, that's, I think, what our viewers are wondering.
Increasing interest rates. Look at gas prices. In June 1st, gas prices were on average like $4.69 a gallon, and they're $4.85 right now. So the run-up has slowed.
Yeah.
And I've heard recently that gas prices have come down, but interest rates are double what they were a year ago. It's just going to make things harder. Why? Because we have to raise rates to make things more expensive, to make growth more expensive, and therefore it'll slow down growth. You might sit there and say, well, that sucks. Well, guys, unfortunately, we cannot have our cake and eat it too. We all want to be rich and have 100% employment and everybody doing great. It's just, that's not the way the world works. The world works in a way of what's better for the masses is having cycles. You get rid of bad businesses during busts, and you have good businesses get even better. The same thing with people. If you're a responsible saver who lives well within your means, you're going to do just fine. And my guess is, if you're watching this channel right now, you probably very much love investing, probably very much love saving, and you probably live well within your means. This is your opportunity. Okay, and more on that later.
So, Paul, we talked about these interest rates. Like, I wanted to put on addition to my home. The rates have since doubled since I thought about it, so I'm just not doing that anymore. This is that slowing that the Fed has done, right?
Exactly. I mean, you're a consumer, and 70% of our GDP is from consumer spending. So when rates go higher, you go from 3% to 6%, you're going to be like, wait a second, if I was going to borrow $200,000 before, that's a difference of, that increase alone is $500 extra a month.
Can't do it.
It's done, and that's okay.
But you're right, I'm sad. I want my cake, and I want to eat it too.
Yeah, exactly. And it's okay to want that. Mm-hmm. It is okay to want that, but just remember, guys, 5%, 5.5% is still a good interest rate based on history. Early 80s, people were paying 15, 16, 17, 18% for loans. It was crazy times back then. Why? Because inflation was very high and they had to fight it somehow. And if inflation gets crazy high and can't be pulled back, there will be an even higher raise in interest rates. But again, if you save well and live well within your means, you will do fine. In fact, you will excel. And all the people out there who live paycheck to paycheck on debt, they're gonna falter, and that's okay. You're living to see another day, and that's what you're happy about. That's what I'm happy about. Yes, my friends tease me, Paul, you've been out of the market for so long. Of course there's gonna be a crash eventually. Okay, guess what? I hear nothing from them now. Bitcoin, Paul, you just don't get it.
Crickets,
19,000. By the way, crypto, Bitcoin is going way lower than it is today. Way lower. Because I look at the markets, I look at people and say, okay, what are they talking about out there? And when the 18-year-old caddy at the country club is telling me I missed it on Palantir, Tesla, and Bitcoin in June of 2021, tell me how all three of those things have done since then. That's the indication to me that things are crazy. There are major cycles to a market bubble. One of them is everyone's a genius and only things can go up. Everyone cannot be a genius. It's literally impossible. If everybody in this country became a doctor, we would have doctors working at McDonald's. And only the best of the best of the best would actually be doctors. That is the point, right? That's what I'm trying to sit there and say. This is a mindset, and that mindset takes time. But the great news is, in our community on this channel, we talk mostly about mindset. The numbers are easy. You can do the numbers. You'll learn the numbers very quickly. The question is, when stocks are falling, can you keep buying? Mm-hmm. When you think a stock is worth 100 and it falls to 70, do you sit there and go, oh boy, am I wrong? You could be wrong. Or you could just be looking at it and saying, this is an opportunity to buy even more stock that I love.
Most of the people in our community, Paul, you have to falter and fail at this first before you finally kind of get it, right?
When you finally get it, then what's going to happen? You're going to falter and fail at that too.
Yeah, I guess you're right.
Listen, that's what life is. I faltered. I screwed up. I just put a quote today in our community. Every day I put a quote in. Today's quote was about never being complacent, never being comfortable. I learned the best from the times that I just absolutely effed up royally. Mm-hmm. And when you're going through it, what do you feel?
Terrible.
You feel awful. You would give anything in the world to go move on from that. But then what does it help you realize later?
Sometimes it's one of the best things that can ever happen to you.
Most times it's the best thing that ever happened to you. Mm-hmm. Most times it is. I can't think of a time where I've sat there and said, this effing sucks. I didn't later on go, thank God that happened. I learned my best investing decisions based on the times when I was like, when my back was against the wall going, what the F am I going to do? Right? Now, the great news is that in this community, you can learn from thousands and thousands of people, including us, about this. It's about learning the mentality of investing. Guy Spear, in his book, The Education of a Value Investor, which, by the way, we're starting with book club tomorrow in our community, but The Education of a Value Investor, he talks about 07, 08, 09, and how all these value investor friends of his who were value investors in 06 and 07, when stocks started to fall, he was the only one who stayed in. Everybody else was like, oh, I'm out. He's like, they were just value investors by name. And you'd be surprised how many people will say to you, oh, if stocks fell in half, of course I'd buy more. Well, yeah, it's easy to say that when stocks have gone like this. Guys, recency bias is huge. All of a sudden, stocks go like this. You're going to be like, oh boy, I'm out. But you don't know if this is part of a chart that looks like this. But if you understand valuation and you understand dollar cost averaging, and you can understand that this is still a great buy for a stock, and you buy a ton here, even if it goes to here, you're buying more along the way. And then all of a sudden you're like, okay, now it's overvalued. I'm not going to buy anymore, but I'm going to keep it. It's going to keep running. That's the goal here. When you understand, the more you know, the less you fear. Because when we're down here falling, we're fearful. Why? If you don't understand valuation, you don't understand what drives stock prices, of course you'll be fearful. I would be fearful. I used to be fearful. Now, it's just a moment of, okay, am I wrong here? The only thing that a stock price falling tells me is if the market is down along with it, I don't worry. But if it's by itself going down, I just think to myself, is my thesis right or wrong? So what do?
Reanalyze.
I reanalyze. I look at the stock again and say, what could I be wrong about here? I'm reanalyzing Carnival Cruise Line right now because I'm like, man, they got a lot more debt than I originally thought they're going to have. They issued way more shares than I thought they're going to issue. So I reanalyze. And that is your job of a value investor. And that's what the first half this year, the worst one in history, has taught us. Reanalyze and learn more.
Yes, Paul, let's get back to this. You said that 70% of the GDP is driven by consumers like me. So where are you going with this one?
So there's a video from the past where I talked about it earlier this month where I did a May recap, and I talked about consumer sentiment, which is the consumer's view on the markets going forward and the economy and their confidence in it. And I said it had a big drop to 58.4, which hadn't been seen in a while. Guys, and I said it was my number one concern about the economy going forward. It is now at 50. Here's May, 58.4. It is currently at 50.
And last year at 85.
And yeah, exactly. 1 year ago, it was 85.5. 41% drop right here. This is big stuff. Look at this. Look at these numbers right here. Guys, 70% of the economy is made up from consumer spending. If consumers are fearful about the economy going forward, what are they going to do?
I am right now too. I'm saving. Well, much like you tell us, I'm saving money. I'm not spending as much.
So let's do the math there.
I'm pulling back. Yeah.
Let's do the math there. If 70% of consumer spending, of GDP is consumer spending, a 10% drop, you sat there and said, listen, I'm going to spend 10% less this month. That's 7% of GDP gone. Guys, 7% of GDP is a big, 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 big number. That's just what people saying, you know what? I don't like it. I'm just going to cut back 10%. They're still buying stuff, but they're buying 10% less, which isn't a ton. You could easily right now in your head go, yeah, I can go to the bar 10% less. I can go to the sports arena 10% less. I can buy 10% less clothes just like that. That would be a 7% drop in GDP. We're scared because the first quarter had a 1.6% drop in GDP. That is the interesting part here, guys.
Have you seen this in real time? I feel like I'm going out. I see less people at restaurants. People are pulling back their travel because of gas.
See, I don't know if maybe I don't pay attention to it. I have not seen that for myself. If you have, that's impressive. But maybe it's also the way in which you're thinking too. Like, oh, I'm scared, things like that.
Yeah, scared.
That could be it. We see the world in which way we see it, not the way it actually is, right? Now, there are things like car sales. I'm going to look at car sales as a big leading indicator for me. Why? Because if I'm fearful of the future, the first thing I'm going to cut back on is, you know what? My 5-year-old car, it's fine. I'm okay. I don't need to buy a new one. But the thing with car sales now is they're still hot and heavy. So it's kind of hard to see that. New home sales. Now, I will say this. The one thing I will say is this. A year and a half ago, I was renovating a house that I bought. And I literally had contractors telling me I can't touch it for 9 months. Now I just bought a new house, sold that one, and I'm getting contractors lined up. Paul, I can start in 6 weeks.
I'm seeing that too, actually.
Are you?
Yeah.
That's what makes me go.
6 months turned into 6 weeks.
Yeah. Oh, I was hearing 9 months. And now we're at like, Paul, 6 weeks. In fact, somebody told me, Paul, I can start the day you close and get this thing done. I was like, well, I'm not ready when the day I close. So those are, again, none of these are one, like, I don't want to make it seem like I see one thing and that's it. No, it's the economy is a very, very, very intricate machine, and it's turning on a lot of wheels, a lot of gears, etc. But when 70% of the economy is consumer driven and consumers are scared at that 50 level rating for consumer sentiment, that is a concern of mine. And I just look at that and say, okay, something's going to happen. Do I agree with Powell when he says that we're on strong footing and we're okay? I don't agree with that. I think he's doing the right thing, which is probably getting some political pressure from people saying, listen, elections are coming up. We need to make this thing last. And I don't blame him. I don't care who's in power. They're both sides. Look at Trump when he was in power. He was sitting there 5 years before he was into office. He was like, these artificial interest rates are terrible for the economy. The second he gets into office, we need lower interest rates. Everybody's going to do that. So go look at it. Even though Powell's not elected, he's still a public official who people are going to look at and say, oh, I lost my job because of him. And he doesn't want to be that guy. Mm-hmm. So he wants to kick the can down the road as much as possible. Now, Cathie Wood, our good friend, thinks we're in a recession already. She's also reacting because her investments have gone to shit, right? Okay. The only thing that makes me think that we're not in a recession is if Cathie Wood says we're in a recession and she's wrong about everything, then we're probably not in a recession. But on this one, I don't know where we are. However, if we're not in a recession, we're teetering. And if consumer sentiment continues to go down, guys, we've got problems. So if you're fearful, just remember this phrase: the more you know, the less you fear. And if you like our videos, please subscribe. Go to youtube.com/everythingmoney. And for our next video, go look at the video on this upcoming recession. Could be the opportunity of a lifetime because it'll really help you look at the glasses half full when recessions hit.